want to say a couple things, just the disclaimers. We are recording it, number one. Number two, any advice that's been deemed to be given is certainly not 180 Markets advice. I'm not sure everyone's AFSL requirements or whatever, but I just want to put that blanket disclaimer out there for everybody, that opinions are people's opinions in themselves. Thank you, everybody, for joining us. Obviously, we know that the markets have been very challenging in the first half of this year. And I'm reminded of that saying, you're not as bad as your worst day and as good as your best day, because obviously the last 2 years have been, absolutely phenomenal. But nevertheless, we are here where we're here. We're in a market cycle. And what we wanted to do is to really bring together an eclectic, different group of people, different brokers that are seeing the market from their vantage point. They all bring a little bit of different expertise. And we were joking before, geographically, they're diverse as well, all across the country. But I think more importantly, they see a different perspective in the markets. And here joined with us, I can see firstly, Harvey Kaplan from Plutus Capital. Harvey certainly knows projects extremely well. We have Jonathan File up in Sydney. Jonathan, say hi. G'day. Very unique perspective, and especially in some of the private market transactions. Scott Fraser from Morgan's in Perth. We'll see the big town. We were just discussing cycling as well. So not only is he looking out for markets, but he's looking out for the pathways as well. We also have with us Michael Holland from Sequoia Capital. Michael, say hi.
Hello.
And then finally, we have my partner, Sean Factor from 180 Markets.
Hi, everyone.
There you go. And again, what we really wanted to do is to bring together a different group of people to see things from their points of view. And just because I'm so familiar with him, Sean, I may start out with you. Can you just tell us a little bit, what are you seeing on the markets? Are you seeing any types of themes?
Thanks, Greg. And in terms of themes, I guess the only one at the moment is the buy now, pay later space. There's definitely been a pretty strong rebound. In percentage terms from the lows, it has been pretty big. But if you compare the prices now to where they were maybe a year ago or even 18 months, they're still way down. So we were looking today at SZL, and that had a big move to the upside. They were actually halted towards the end of the day. So, I mean, they pretty much doubled today before the ASX stopped the trading and presented them with a speeding ticket. I mean, they closed at 70 cents, which, up 100% in the day is great, but it's still only trading at about 1/10 of where they were. And that's pretty common in the buy now, pay later space. I was actually watching a stock today, Spender, the code's SPX, so they are in that space as well. So every other stock in the in buy now, pay later space was going nuts, and this one was doing nothing. It was trading at 1.2, and then I think there was a post on Hot Copper or something just reminding people. It went from 1.2 to 1.7 in about 10 minutes. Wow. Just because people remembered the kind of stock that it is. They used to be the old
Seralto, wasn't it?
Correct. Yeah, Seralto. So they hit, I think they hit 10 cents back in the day. I think I'd say, I'm just looking at the chart here. So in February 2021, they hit 12 cents. Pretty sure they raised money around 8. And then they've now fallen with all the other stocks in the sector. Pretty much forgotten about, very illiquid, and then just out of nowhere, it just went up quite a bit today. So, I mean, that's all we've seen. There's many beaten down stocks that people have forgotten about, suffering from a lack of liquidity, and then people just get reminded and they can move pretty quickly. But apart from that sector, there's not much else to be excited about.
Okay, guys, and this is for anybody, nobody specifically. Sean mentioned the word liquidity. Obviously, I think that one of the big differences between now, though, and call it 2008, 2009, are investors' liquidity. Does anybody have any comments about their clients as far as, are they cashed up but nervous? Are they overextended? Does anybody have any view on, where is investors' cash positions?
Yeah, I'll jump in on that one, Greg. So, probably over the last 6 months, clients have been happy to take a fair bit of money out of markets. We saw large swings prior to June, just with thematics coming through, and particularly with oil booming up to the top, and some of the commodities too, in agri and stuff like that. So easy to take money out of some of the big names, even go underweight and still maintain positions there. But particularly with sitting on, probably taking portfolios from what usually carry, what leading into a reporting season probably carry around 15 to 20%, probably taking that up over 30% cash if possible in portfolios. And like Sean sort of touched on, there's not a lot of excitement happening with thematic trades at the moment. And I was just going to touch on the themes, was it's all about patient money. So if your investors have got time on their hands and are quite happy to accumulate, there's some pretty good stories to be picking up, but you've got to have the stomach to weather the storm, because there's some pretty good valuations kicking around.
Got it. Michael, what about you? Because you obviously have a diverse client base as well. What are you seeing?
Yeah, so obviously very different for us. We're less private client and more corporate. So there's been a prevalence of fund or companies that are going to have to come to the market and raise money. We're seeing that with 4Cs, especially coming out this week, and some relatively distressed balance sheets. So I think what we're seeing there is what we're calling essentially a recapitalisation trade, but also a necessity to look for alternate funding sources. So in the last 2 years, as you mentioned before, Greg, equity markets have basically been just a tap where you can continually go back to whenever you really need it. Now it's not as easy as it once was. So I think you're seeing a lot of alternative funding, be it con notes, debt, warrant kind of facilities that you're seeing companies have to look at, and certainly fewer straight placements, very few SPPs and rights issues, which I think also speaks to the state of the market very much itself in the last 6 or so months.
Yeah, and maybe if someone could chime in, because there are a lot of investors on that would not be familiar with why SPPs or rights issues don't necessarily work right now. Can anybody just explain at a high level how, if the share prices are trading down, why they wouldn't have very big take up?
I can go, Greg.
Yeah, that would be great if you don't mind.
Yeah, so I guess for an SPP or rights issue, usually to be successful, you need the price to be above the issue price. And in this market, you rarely see that. So a lot of companies still like to do a rights issue or SPP, but they get a bit surprised at the end where they haven't got a big take up because investors can buy shares on the market cheaper. And that's a kind of environment we're in now. It's pretty rare that you see a rights issue or SPP trading above that price. So, I mean, if a company wants to do a rights issue successfully, you usually have to speak to your larger investors first and try and organize it. So, yeah, but we're not seeing a lot of success in that space.
Also, I'll just jump in on that too. A lot of brokers just don't have the balance sheets to underwrite SPPs and the like. So to take that risk on as a broker in this space, they're not willing to sort of risk their capital.
That's right.
Gotcha. Hey guys, and I guess Jonathan, just switching a little bit, you do a lot in the private markets as well as public markets. I'm just curious, what are you seeing in the private space? Because I think there's also, even for those of us that don't necessarily traffic there, there's a lot of crossover.
Yeah, look, for me, I've always loved finding private businesses and I guess taking them through the journey of funding and, rolling up the sleeves, getting them to market. That's been my experience. But I'm seeing now that, it's sort of, you've had a lot of, take VC, like VC, I think your Blackbirds, groups like that are only starting to kind of swallow the pill. They did their retail on Canva and plays like that. And, there's obviously a lot of rules there where there's a bit of a lag. So a lot of the private guys are starting to see, I don't know, take something like Milk Run. It raised $75 million at, a massive valuation in January. It's the kind of business that, you'd look at it now and go, they're probably getting to that stage where they have to raise again. And there's a lot of businesses like that. And they have to have that sort of come to Jesus moment where the valuation has to catch up to the listed world. So you're seeing valuations certainly come down. And like Michael pointed to, you're getting into those more exotic structures, your con notes and, I guess other facilities like that. So, look, it's getting interesting. I sort of, love the idea of sort of looking at a few of these things and, can you tack them on to a few listed plays you might be involved in? You can kind of get quite innovative.
Right. And also, just as a follow on, in the private space, are you seeing, and I know this is a blanket statement, are companies still able to get funded, albeit they just don't love the terms, or is it like the market's just completely shut in the private space?
It's a show me rather than tell me market. You're having businesses where we can't really be using revenue multiples and things like that. It's like, no, you got to start getting an idea of what your free cash flow is and real multiples. So if you've got real earnings, you can certainly have a chat. But the idea that you can value something on a revenue multiple, things like that are just out the window.
Gotcha. And speaking of real earnings, or real for that matter, Harvey, real projects. Obviously, we know that the ASX is fraught with many companies out there that don't really have real projects. I'm curious, do you see people now or investors really trying to roll up their sleeves to find those real projects that are out there? Because certainly the prices are right now.
Absolutely. I mean, the reality is we've seen many downturns over my time in the market. And when we come out of these sorts of markets, the first companies that rebound are those with the high quality projects. So, I mean, speaking of a different space, the lithium space, there's like a complete disconnect at the moment between, the valuations that the market's giving to lithium companies as opposed to what those producers are actually able to sell their product for. So, companies like Pilbara are generating enormous amount of cash because they're actually producing. So they wouldn't have been hit as much as some of these other non-producers. And similarly, I think that, when the market starts to recover, the producers will always be the ones that will rally first, then the emerging producers, and only lastly, sort of your explorers will emerge. So look, right now, you can certainly start negotiating at a much lower level than you could 6 months ago.
Yeah, and I was curious, to follow on it is, do you see those producers starting to look at these emerging companies or explorers because to try to do some type of M&A transaction or earn-in deals because the valuations are more achievable, I suppose?
Absolutely. I mean, if you believe in the space, now's as good a time as any to try and, tie an area, geographic region or an area up. And I mean, you're seeing a lot of the deals a lot of people wouldn't be familiar with because, they've done off market, and not via listed entities, but certainly right now is exactly the time that these producers would look to try and, tie production for a long time into the future.
Great. And now I want to turn it back to Sean for a second. Sean, one of the sayings is that about 90% of your money is made in about 10% of your time in the markets. And obviously, you're an incredible market timer. What are you doing right now? And what do you advise people? Or I shouldn't say advise people, but what are you doing right now?
I went shopping today, so had to go with my wife shopping. But that's like I saw a bad market overnight. It was down 200 or so. I pretty much thought, okay, today's a write-off. So I told my wife today's the day we can go out for lunch and coffee and shopping. But yeah, it's I try to stay away from the screens on the bad days. In this sort of market, it's very low, as we've said before, very low liquidity, and sometimes you feel like you'd only buy out there. So you're buying stocks and the next day it's cheaper, and then the next day after that it's cheaper. So while there are a few stocks going up and bouncing, it's very hard to pick. It is a real stock pickers market at the moment. There are a lot more losers out there than winners. So in times like this, I'd rather miss the first 10 to 15% of the bounce, of any bounce. Rather play the market when the volume's there. Sure, we may have gone up 30% or something, but that's when I find all the money is there to be made. If we look back in 2020, there were some amazing opportunities when the market fell, but had you been holding them before then, you would have been wiped out. So we had a pretty good market there for a long time, and I feel now we're having a consequence of all that success in the market. So the lack of liquidity now is just the complete opposite of the massive liquidity we did have back in those days. So it's a completely different market now.
Right. It's certainly become more of a buyer's market. And specifically, one investor base that I know that all of you cover are the family offices. And this question is for anybody. What do you all see being done from the family office side? Because a lot of times those are patient buyers. A lot of them, frankly, feel like that they missed that 2010 through 2012 period. What are you seeing from that cadre of people?
I'll happily jump in there, Greg.
Yeah.
I would say from that particular group, we're seeing more due diligence. So before they're making any kind of investment, it might have used to be 2 to 3 meetings. Now it's 4, 5, 6, really getting into management, really delving really deep into financial models. It's slower decision times than we've probably seen in the past. And even getting to the point of portfolio strategies where it's basically, if I'm going to invest in this, it's got to be better than something I already have. So it's one in, one out for a lot of them. Right. So yeah, it's a slow decision process, but it's always a very methodical decision process.
Yeah, and also, Michael, do you think that, frankly, there's been such a FOMO, a fear of missing out, that now it's almost swung the other direction, where, as you said, they're doing 6, 7 meetings and so forth and so on, hiring engineering experts and as such? Yeah,
you're absolutely right. Like, there's third-party consultants they're getting in, so they really want to have every bit of information they possibly can before making an informed decision. Is it overkill? Maybe, but that's their right to do it. Yeah, I think you're probably in the ballpark there. I think it's interesting to what Sean was previously saying, right? You're happy to miss the first 10 to 15%. They're very much in that camp, but it's also figuring out why or where that 10 to 15% is coming from. So if we're looking at names like Sezzle that you talked about before, these stocks that just got absolutely hammered before June 30, and was that tax losses and people just willing to sell at any cost basically at that point. And then you see that little bounce back after that period. So yeah, it's whether or not that bounce is sustainable, I suppose, and whether you want to be a part of that rally.
Yep, got it. And everybody here, obviously, we're very involved in equity capital markets or capital markets in general. And again, this question is for everyone. Clearly, the capital markets activity is a lot lower at this point in time. What are you telling your clients if they do participate in a capital raise about how they should be thinking about it, what they should be doing?
I'll jump in there, Greg. Look, the reality is you would hope that most companies raise sufficient money when they could. So, I mean, there's always companies need money for acquisitions, something. So you really have to, be very, very particular about the raises that you do take at the moment. The idea that you could just take any placement or rights issue and then sell it, a few weeks later and clip 10 or 15%, or even sell your shares and keep options. I mean, that's just not there anymore. There's no liquidity just soak that up. So if you're taking something at the moment, you've really got to like the story and be prepared to hold it for longer.
And even potentially buy more if it drops?
Absolutely. I mean, the reality is if you like something at 5 cents and, you know, then trades at 4.7 and you never got as many as you want, well, there's no good reason not to be buying more.
And that also speaks to the quality of the books that you're seeing, Harvey. Like, you're not seeing things 3 to 4 times covered anymore. You might see 1 to 2 times at absolute max. And so that wave of buying that might be lined, or that would be lined up to support it in the aftermarket, just isn't as prevalent as it once was.
Yeah.
Yeah, I'll comment on that book too. I mean, you used to see corporate advisors just throw everyone into the book and give everyone a slice of the pie. And nowadays, well, particularly in the last 6 months, we've seen corporate advisors just really tighten the distribution up, keep it really tight. Morgans today did a raise for a New Zealand gold company, and the founder in behind that stated that it didn't want it to go far and wide. It was just to certain shareholders, and it still had to be done at a really savage discount, but to get it away. But yeah, it's really the quality of the books, almost the most important factor these days.
Right. And also, you know, especially in the smaller capitalization companies, for everyone here, I know the 4 Cs, which are the quarterly reports, are coming out. They're all due out, I believe, in the next 3 days, where they'll show a lot of companies' cash positions and activities. What is everybody expecting to see from those companies that are underfunded?
Well, just going to hop in there. And look, it goes back to kind of thinking about what sectors, what themes you're getting into, and moving with, you know, I guess what's happening in the world at the moment. Look, the overall summary is that, you know, say in resource land, obviously cost of production, you know, logistics, labor, that's all gone to the roof. So it's factoring in that, you know, reconciling with that, you're saying, well, what is the resource they have? What's the quality? You know, what's the grade? What's the production profile? But then, yeah, just going back to thinking about quarterlies, it's like, okay, you're going to get, at least in my realm, it's like you're going to get a lot of companies that probably don't have much firepower left. And again, consolidation is a big thing that someone like myself starts to think. I'm someone who likes to work with companies and start thinking, okay, what's your peer group? You know, if you've got a capitalized company, can you start to use your script, maybe a bit of cash, start to scale up your business? So I think that's another thing with consolidation. If you can get scale, if you can get critical mass, you're probably someone who's going to win out there at the moment.
Right. That certainly makes sense. And Harvey, Harvey,
Greg, I was just going to comment too. It's really sector based. Like, you're going to have a whole lot of explorers come out that have got basically cents to the dollar and be desperate for cash. I think Michael mentioned, you know, just basically total recapitalize of the businesses. Whereas you look at some of these tech businesses and stuff that have been smashed and are burning cash, either due expensive overheads or the likes. And you're going to have some of the big behemoths be able to come through and buy these businesses super cheap and just acquire them and take them off the boards and see that thing be spit out in 5 years' time.
Yeah, just really quickly on that, you've got some acquisitive spaces like biotech, and one theme that I saw emerge, you know, I call it the last couple of months, is you had a lot of biotech names that, you know, a lot of the bigger brokers, they brought to market, and some of these names ended up trading at cash or even slightly below. And some of those businesses are interesting. I'm certainly not a biotech expert. I rely on others, but just looking at your balance sheets there, you start to go, there's some pretty big sharks out there that might look at these businesses and go, this is quite interesting. Or maybe, you know, some of them with big cash piles become the acquirer in our market.
Yeah, totally agree. I think maybe slight differentiation of biotech, but medtech, you're seeing medtech with real revenue,
right.
and you can foresee the balance sheet being cash flow positive. I mean, that's the type of business that you kind of see the opportunity today picking up on a cheap FY24, FY25 multiple, and you know, the behemoths are going to see these medtechs as something that they can parcel together and be a vertical integrated business to your pathology labs or the likes.
Yeah, Scott, and just curious, following on that as well, are you seeing, in to the degree you can comment, maybe some of the overseas medical companies coming to start to kick the tires with the dollar at 0.69, as you said, some share prices getting smashed? Are you seeing any of that type of early days activity?
We certainly, I mean, a company that Morgans follow quite closely, Volpara, VHT. I mean, you've seen a new CEO come in. She's essentially cleaned the slate, rejigged, redone the strategy, and you've seen them do a deal with Microsoft straight off the bat. It's not an equity deal, so they're just basically dipping their toe in the water. But certainly,
I think
did the same with Microsoft again. That's at the total opposite end of the market. But yeah, I totally agree that you're starting to see overseas companies start to. I mean, Australia has forever and a day got a great industry of tech in the medical and science realms. So it's now the ripening. I know a few private deals where you've got some big medical industrial businesses, well, big for Australia, being taken over by US private equity firms because of certain key factors around vertical integration or just the fact that they can buy it on cheap valuations.
Got it. Okay, so here, turning to something about that is a little bit more fun. It's very rare, as I mentioned earlier, that the new bull market starts from the old bull market sectors. Does anybody have any predictions about what is the sector that will lead the next bull market?
I hate to say it, but it's probably boring. Like with interest rates going where they're going, you're probably going to see a lot of interest in infrastructure, the old tried and tested method of buying value.
Right.
You can cast your eye over the 200 and see valuations are pretty cheap on the big stuff. So I think that will lead the bull market momentum, and then you'll have all the small caps sort of follow behind. It won't be the other way around, which we've had for the last 10 years or so.
Yep.
And could it be like alternative infrastructure stuff? So I know we're doing something at the moment in like energy transition space. So essentially, we'll agree and we'll get the fact that Australia in 20, 30 years will be completely run on clean energy, not disputing that at all, but how viable that is in the next 5 to 10 years, right? So we've got to kind of bridge that gap. So yeah, I think there's a number of energy and infrastructure projects that can do that over the next little while. So that could be something, as you say, smalls are always fun if you want to have a little bull market.
Yeah, and Michael, are you still seeing a lot of capital available for those types of clean projects?
Yeah, very much so. I think like it's overstated, but literally every person you go to says, what's your ESG credentials? We're seeing basically every slide deck and investment pack we put together has 1 to 2 slides on ESG. One of my favorite lines is, this isn't ESG because it's trendy, it's ESG because it's actually ESG. Right. So that's a nice one. I think there's capital there. It's also and I think this is probably a broader market thematic as well, right? No one wants to be the first check at the moment. Everyone's happy to come in after 1 or 2 groups have come in. So yeah, we're working on a project that's just been 50% equity funded, and now suddenly people are really excited about it. Staggering, right?
That's generally the buyers are higher and the sellers are lower. I certainly understand that. Sean, obviously, as you well know, emotions play a big part in share markets as much as balance sheets and income statements. How do you keep yourself? You're a pretty cool customer under pressure. I've even seen you be called a twit before and not panic. How do you keep yourself calm when there's things are not going your way?
Yeah, look, that's a pretty good question, and it can be pretty hard, especially at the moment. But I guess it's only money. There's a lot more important things out there. So yeah, it's look, there's when you are trading the market, there's definitely a lot of different frustrations that you feel, and yeah, if you try and learn your lessons from the past and try and stay calm, I guess that'll help you. But just something on the previous topic, Greg, of old sectors and what we're going to see was I mean, everybody paused. Nobody could pretty confidently say a sector that they'd be comfortable recommending or predicting. I think that's the whole thing with what we see with the market. It's generally a surprise. So especially in the small and micro caps, one thing you see from bull to bear market and then back to bull market is the old sectors are very rarely the old good sectors are very rarely the good sectors again. Like I remember back in, let's say, I think it was about 7-8 years ago when cobalt was hot. The market was really hot and cobalt stocks were pretty much like lithium now. And then the market cooled down and people were still in love with cobalt stocks, and I definitely was. And you just couldn't understand why there was no buying coming back into those stocks. And then, yeah, I mean, it's like people forget about that, and we haven't had cobalt again for quite a while. So it's very hard to predict what sector will pop up next, especially in the smaller micro caps. So it usually is a surprise. It's very hard. I mean, if anyone can be pretty confident in picking it, yeah, it's very hard to pick.
Got it. Well, Sean, you're a testament that you don't have to necessarily predict that to still be profitable in the market. So we
well,
should,
as I said before, and I think everyone agrees, if you don't mind missing the first 10 to say 30%, you can still enjoy the party while it's there. You don't need to start off the party.
great. You can be fashionably late.
Exactly.
Speaking of, we're trying to keep it to a half hour, but we're already over a little bit. I just want to open it up now to Q&A. Anybody that wants to ask a question, just feel free to go for it. If you want to WhatsApp me as well, or Sean even, that's totally fine. But we just want to give everyone a chance to participate and to hear other people's thoughts. Okay, somebody is asking me a question. At the project level, and I assume that this is for commodities, are you seeing people looking to vend projects into listed companies? Harvey, maybe, I don't know if you would, anybody may see that, but Harvey, I would think you especially.
Look, there's always people trying to vend projects in. We went through a period where people were literally pegging ground, spending, $10,000 and then trying to vend it in and, value it at $1 million, for example. But yeah, right now for a listed entity to want to do a deal on some ground, it's got to be pretty good ground. Things are very, very different to what they were 6 or even 12 months ago. So, once again, much like, people taking more meetings, people doing more due diligence, people are pickier. You've really got to have something good in order for people to want to have it become their new project.
Got it. Okay, I'm getting another question, and would you rather invest in the private markets or public markets right now? That's a very open-ended question, but if anyone has any thoughts, I'll be glad to hear them.
Happy to hop in. It's just, it all comes down to value and what are you buying? I think at the moment, again, going back to your idea that you have quarterlies coming up, and yeah, it is a bit of a revelation period. And, someone like Michael, as he was saying, he's seeing more transactions there. It's just keeping your eyes open. There's obviously a lot of acquisitive behavior in different sectors. The gold players, there's been of activity there with Dacian, I guess, at least for me, sort of Tasmania's big focus. You've had Twiggy Forest and Cooks and people like that, obviously getting pretty active in Huon and Tassel. So it's just having a critical think about sectors and where do you find value.
Also, I think the fundies at the moment, like your Twiggies or whatever, I've forgotten who said it, maybe it was Harvey, was basically can dictate terms. So if you're in the private space, you pretty much know that that vehicle has got nowhere else to go for money, so they can determine what they want and how much of it. And then if you're in the public space, well, you're only in the public space for liquidity, really. So that's
good.
Sorry?
Sorry, I think you guys been across it. Good to see Genix the other day, some activity there. Obviously the Atlassian boys are certainly not afraid to deploy a bit of dough. So
yeah, well, I think one's trying to outdo the other in that space with either you got a sun cable up the north of WA or the other one's going to go and buy a couple of old dusty gold mine pits and fill it up with water. So
properties and
but I suppose that transaction itself is just a myriad of where we are on the economics or the investment market cycle. How many M&A deals have you seen in the last 2 weeks that kind of starts to smell that we're in this period where the cycle's moving to M&A, and next thing you know, we'll be back at the races in the next few months.
Got it. Hey guys, there's a question. Obviously, everyone's got, I guess, an opinion. What is your view on gold prices over the next year?
I'm a gold bull. I mean, history says that when you're in a significant inflationary environment, gold goes up. There are probably a few other factors in terms of the war in Ukraine and the fact that Russia's obviously got gold to spend, and that might account for why the gold price hasn't gone up. But certainly, I'm very optimistic about, the gold price over the next 12 to 18 months.
Right. So Harvey, are you saying that you think that the war is actually putting pressure on gold prices?
Well, I don't want to be a conspiracy theorist, but there is a significant school of thought that says that the gold price is not being allowed to go up as much because Russia would obviously have a lot more spending power with such significant gold reserves.
Yeah, I think it was Goldie's or one of the big US banks came out saying that basically because they've shut the banking system down to Russia, the only way for Russia to pay for goods and to get cash is through gold at the moment. So that's why there's Russia's just providing a whole lot of liquidity in that gold market.
Got it. Someone's asking a stock-specific breakout, the question mark. I would say that I think what they're trying to say is, are there any stocks that are specifically breaking out? I guess the buy now, pay later Sezzle would, I guess Sezzle would be in that category.
I reckon an easy way to pick out a breakout would be obviously just look at your top stocks that are shorted. If there's a squeeze event, I mean, who knows what happens with the US meeting interest rates tonight. If that isn't as big as what everyone has expected, well, then we could see a huge push on the market, and that will drive out a lot of shorts.
Yeah, used to be that good website. It's got about days to cover, which is essentially the amount of days it would cover, or it would take for all the volume in a stock to get rid of the shorts. So that's always a good one to look at.
Yeah. Got
it. Copper, the commodity, supply demand. Do you think copper could be the next hot sector? Does not seem to be enough supply to meet the demand.
Yeah, I might just hop in there. I think it's a supply shock event away from getting back on track. I think it's one of these things, copper, that globally you look at the grade of the mega projects that are out there, it's always declining. And, you constantly hear things out of, whether it's Escondida or wherever, where they have pit wall failures or what have you. It's only sort of one supply shock. And obviously even inventory levels, dwindling inventory levels, things like that, which become top of mind again, that can obviously reignite the market.
I think Wood Mac last week published a paper on just how much the big miners have failed to invest in new big projects, and that's leading to a massive drop off in a lot of commodities in supply. But copper, I don't know, copper just seems like it's one of those commodities that is almost like nickel. There's grade to be found and there's grade to be had, but projects just aren't coming on board fast enough. But yet the copper price just doesn't seem to maintain its buoyancy due to the tightness.
Got it. Because I'm getting another question. I'm a commodity investor. Do you think that I should be buying producing companies now versus explorers?
Well,
Yes,
you go, Sean.
I was just going to say, it comes down to your risk versus reward. Yeah, how risky is that your last 10% or of your portfolio, or are you prepared to lose it? If you are, go for an explorer. If not, just go for a safer producer.
Yep. I guess, and then it absolutely certainly makes sense. You don't want to put your last dollar into them. The question is for Scott, for you. Are you seeing any type of asset reallocation that within your portfolios?
Well, yeah, I suppose without trying to delve into the type of client that's investing, but I think generally, I think the easy rewards, as Sean was sort of highlighting, easy rewards are kind of like in the top end with valuations being down. So probably putting a little bit of money to work in the top end. Some smaller names that portfolios picked up in the last year or two, like they've got, and it comes back to Harvey's sort of point, you've got to have good metrics on a decent project. If it's a decent project, well, you knew that it's going to be going through 1 or 2 cycles anyway. So now is probably as good a time as any to top up in some of those decent projects. But no, look, asset allocation pretty much. I know some of the big players have sort of spoken about picking up fixed interest because of where interest rates are at. But I don't think you really need to swing too wildly in asset allocation at the moment.
Got it. Hey, everybody, we just have to keep it wrapped up here now because we really are about 15 minutes over time. Thank you, everybody, for joining us. If you do have any further questions, just let us know. We'll make sure that the appropriate person gets back to you. To all our guests out there, thank you so much. We really appreciate it. We know that it's late on the East Coast, and really thank you very much. Bye. Thanks for watching another episode of 180 Markets. If you want access to thousands of capital raises, sign up at 180markets.com.au and you'll get access to our very next capital raise. Thanks for watching.